Ben, it's been kind of a day of callbacks for me. We're in that era, not just to the dot-com bubble, but also I love the GameStop story. Reminds me of the Predators ball, right, as Mike Milken holds his conference out west. What do you think about this narrow breadth? Like, can we broaden out from here? It's not too late.
No, if you look at the S&P 500, as you noted, we're at an all-time high. But the median stock in the S&P is still about 13% below its own respective high. That's one of the widest gaps we've seen in about 25 years, to your point, since the dot-com bubble. So it does raise some signs, perhaps yellow flags, looking at the market. The good news is we understand why some of that has happened. And if the war continues to improve, if we see energy prices recede a little bit, I think the base case should be a broadening both of earnings and of stock performance across the market.
How much does the war really matter? I keep trying to understand this because when I look at earnings expectations, they continue to ratchet higher, right? And I know that's for the average, but you would think that oil prices, that inflation would eat into some of those profits, and it doesn't seem like analysts across the industry are lowering them at all.
You're right that the index level earnings have been very strong, and they've mostly been driven by AI, although not exclusively. For example, the median S&P 500 stock is tracking earnings growth of about 12% this quarter, which is very strong. But if you look under the surface of the market,
that's the median as opposed to the mean, so it's very important.
Correct.
Right?
Stock
that's
number 250 or 251. Right? But if you dig in by sector, actually, the median stock in most sectors has seen margin estimates cut for the next quarter. And so I do think there are some clear signs in the market that, yes, higher energy costs are having an impact. It's just that they're being outweighed by all of the tailwinds.
So does that mean there's still room to run if the average is it the mean average or the median average stock below its 13% high? Because if the median is still expected to continue growing earnings, but it's not at its high yet, I would want to buy that, right?
I think that's exactly right. And to your point, there are a lot of comparisons between today and what we saw in the market 25 years ago. But one of the key differences, in my view, is the importance of earnings in driving the current market. And what that means is, even though the equity market is at an all-time high, the PE multiple today is still about 10% below where it was a couple months ago, just because of that earnings tailwind.
Yeah, I was telling you that when I started in this job 26 years ago in Frankfurt, all of the CEOs I talked to were talking about churning revenue and didn't care about profit growth. Here, of course, we have the biggest companies in the S&P making an absolute ton of cash, for the most part. They're all positive free cash flow. What about the companies that aren't? Goldman Sachs has an index of unprofitable companies, but a lot of them are like neo-cloud companies, which obviously you still want to own in this AI boom, right?
I think that's right. I'd say generally when we look across the market, we see a pretty rational earnings-driven story. Maybe all of those earnings aren't happening today, but that's typically the case with equities. If you think about an equity, if you're paying roughly 20 times PE, implicitly you're buying a very long stream of future earnings. And actually, we just did an analysis last week. If you look at the S&P 500 through the lens of a discounted cash flow model, about 75% of the value is 10 years and out. So the fact that a company isn't making earnings today is not necessarily so concerning.